I mean, look, it seems that particularly oil investors right now are really responding to those shareholder returns. I mean, what BP has done is not only beat on the expected buyback over the next couple of quarters, but giving clarity to what that buyback, at least a minimum amount of what that buyback will be over the next couple of years. And that's been a big sticking point with investors who quite honestly have been confused by this idea of 60% of surplus cash, or, it really didn't give them the certainty they needed to be able to invest for a longer term.
Not everyone's like Bluebell, who are perhaps more aggressive on the delineation between hydrocarbons and low-cost energy products as well, renewable products. But there are a lot of shareholders who are just scratching their heads going, did BP go too far? Should they be doing what Sawan is doing at Shell, which is just changing the landscape a little bit in terms of the mix as well? Again, same question really. We don't have any clarity from Murray Auchincloss yet about if he's going to change from Bernard Looney's strategy on renewables, do we? I
mean, look, Murray and I think BP's choice of an internal candidate, and particularly choosing Murray, I think is a reinforcement of that strategy. I mean, it shows that the board would like to see that continue. Now, to me, what I think is really interesting is we've got BP shares up, about 6% or so. Back in February 2023, we saw Bernard Looney shift that strategy a little bit back towards oil and gas, committing to produce more oil and gas through 2030, even if it came at the expense of having to relax some emissions targets. And we saw BP shares jump up about 8%. I mean, to me, what this says is shareholders are really interested in how much money they're going to get, and they need confidence that the underlying strategy can deliver it. But I think they're less concerned about how they necessarily, what that strategy is necessarily.
Now, we're just picking through some of the strengths in the numbers today. A strong gas marketing and trading result. The trading result was weaker in the third quarter than expectations, and that's where we saw some of the underperformance in the stock as well. Now we've got a stronger gas performance. We've seen this also from the likes of Shell. How likely is that to continue for the rest of this year?
Look, I mean, it's always difficult to predict trading performance, and that's why particularly the majors tend not to forecast this as much. But I mean, it's a really important part of the overall financial story for these companies. Whether or not that proceeds really is going to depend on, what types of differentials that we see between markets, whether that's European pricing versus Asian pricing, and whether or not companies like BP can capture those differentials. The closer we see markets, particularly between the main LNG buyers in Europe and Asia, the closer we see those markets coming together, the less opportunity there is for that arbitrage.
Noah, when it comes to the refining margins, the weakness cited here as well, significantly weaker was the line that they've used, but we've seen this across the industry. Given the macro headwinds this year, is it right to predict that the refining margins will be challenged for the rest of 2024?
Look, I think now we've seen certain, diesel prices are up quite a bit, and jet fuel prices are up quite a bit, particularly in Europe. So there is some potential green shoots there. But I mean, overall, we've seen margins challenged. Now, BP has flagged as well that we're likely to see lower maintenance at its refineries in the year ahead, or more ratable. And so that can also help out when it comes to the overall results in that part of the business.